Get right over to the big takeaway from yesterday's Fed decision. Steve Leisman joins us. Steve, saw you asking the first question. It was a good question. And I think the question that remains today is the market going to listen to what Jay Powell was saying, that higher rates are coming?
It doesn't seem like it's today, Becky. As you know, the Fed hiked 50 basis points yesterday, stepping down from those historic 75 basis point hikes, but still signaling more rate hikes ahead in the fight against inflation. The Fed said ongoing rate hikes would be appropriate. And the median forecast of Fed officials for the funds rate next year rose to 5.15%. By the way, that was right in line with the forecast of the CNBC Fed survey. That's up from 4.6% in their September outlook. It's also substantially, as Becky suggests here, and increasingly above the market's own outlook for the year-end 2023, which this morning is at 438. So that's quite a gap there. Now, this may not be a problem now since the Fed and the market are in good agreement through the spring. And the Fed said it's going to slow down to feel its way to the right level, likely hiking next by 25 basis points. Here's what Krishna Guha of Evercore ISI wrote. Quote, by targeting a higher for longer peak rate, but slowing down, the Fed prepares for the adverse inflation case while allowing time for the data to falsify its inflation pessimism. Could be a bigger problem next year if the Fed keeps going while the market is priced for cuts and the Fed loses its ability to steer financial conditions. How hawkish is the Fed? Take a look here. 17 Fed officials have rate projections for next year over 5%. 7 are over 5.4%, suggesting a solidly hawkish contingent on the Fed. One official is at 563 through 2025. Your dovish contingents on the left there, just a couple of them, and they're just barely below 5%. Powell welcomed the recent better than expected inflation report, the second in a row, but he pointed out that, hey, inflation's still running at 7.1% year over year, not a reason to be crazy dovish, and that it would take, quote, substantially more evidence to give confidence that inflation is moving towards the 2% target for the Fed to ease back on rate hikes. So, Becky, disagreement now that maybe has tremendous consequences down the road.
Hey, Steve, there's that old joke where, ship steaming ahead sees another ship in its way, radios out and said, change your course. I'm headed your way. And the other guy radios back and said, no, you change your course. First guy gets mad and says, I'm the commanding officer of a U.S. aircraft carrier. Change your course, I order you. The other guy radios back and says, I'm a lighthouse. You change your course. So is the Fed the lighthouse or is the Treasury market?
I don't think either is a lighthouse. I kind of think they're both ships with the ability to change and to move. It's kind of interesting. We talked about this yesterday where I told you that I didn't think Powell could get up there and be very dovish, given that, in his own words, he said that the current inflation rate, take the core, is 3 times the Fed's target rate. So it has to maintain that course, to use your idea there, and can't really change. And what's more interesting is they kind of sped up. And I think what's interesting about your analogy there, Becky, is whether or not there's kind of a crash coming. And if you look at the Fed rate outlook through the spring, not much disagreement there. The May 2023 contract trading around 490. That's about where the Fed probably gets to if you start to do the math and say, let's say they do a couple more quarters from here. That's okay. And I guess it's okay for the Fed to be wrong here, and then change course if the market ends up being right. The trouble right now is that it's clear that Powell wants tighter financial conditions now to deal with inflation, and he's not getting it. If you look at what's happened to the Goldman Sachs Financial Conditions Index, it has eased quite a bit while the Fed has hiked quite a bit. So we'll see if the chair and the Fed and the economy don't get the tightening that's necessary to bring down inflation. The market has a different view of the outlook here and the trajectory and the path of the ship of the economy, so to speak, where inflation comes down either with a recession or without one.